So you want to own a mobile home park, 100 pad sites, a plot of dirt, a couple of gravel driveways, and a network of subsurface PVC pipes. Zero structural building maintenance, zero roof repairs, and zero unit turnover costs. On paper, it looks like the ultimate real estate cheat code. You lease the dirt, the tenant owns the house, and every month, a steady stream of non-discretionary rent checks flows into your bank account while you sit on a beach. It sounds like the laziest money printing operation in American real estate. It isn't, because under the quiet surface of this low-maintenance asset lies a brutal operational paradox. You are selling real estate security to a tenant base with zero financial mobility, using an asset that costs more to move than it's worth, connected to aging underground utility systems that can bankrupt you without warning. Welcome to the economics of owning a mobile home park. The entry point for this business sits cleanly across three financial tiers. At the bottom is the local operator level, a $750,000 to $1.5 million purchase price. This gets you a 20 to 30 pad park in a rural or secondary market, often operating on private utilities, a septic tank and a water wellhead. You are buying high-friction cash flow and a full-time job managing individual tenant friction. At the middle tier sits the regional portfolio level, $5 million to $15 million. Here you acquire 80 to 200 pads across 2 or 3 municipal service locations. You hand off day-to-day operations to third-party management companies, swapping operational drag for institutional debt service and capital expenditure reserve requirements. Then comes the institutional elite level, $50 million and above. This is the domain of private equity consolidators and specialized real estate investment trusts. They don't buy individual parks. They buy massive multi-state portfolios, aggregate hundreds of lot rent revenue streams, compress cap rates through aggressive debt packaging, and sell the bundled yield to pension funds and sovereign wealth entities. To understand why institutional money flooded this space over the last decade, you have to look at the core revenue engine. Think of a mobile home park, not as an apartment complex, but as a marina built on dry land. In a standard apartment building, you own the walls, the plumbing, the HVAC unit, and the roof. When a tenant leaves, you spend thousands of dollars repainting walls, replacing carpets, and hunting for a new renter. In a pure lot rent mobile home park model, you own none of the housing structure. You simply lease the concrete pad beneath it and the right to plug into your utility mains. The tenant buys their own manufactured home, parks it on your dirt, and pays you $400 to $900 a month just for the right to let it sit there. This creates the most powerful economic moat in real estate. Near zero tenant turnover. Moving a manufactured home isn't like moving out of an apartment with a U-Haul. Transporting a single-wide mobile home requires specialized heavy haul transport permits, pilot cars, utility line drops, and crane rigging. The physical act of unhooking, transporting, resiting, and reconnecting a unit costs between $5,000 and $10,000. For a family living in a low-income housing bracket, that moving fee is an insurmountable barrier. If you raise their monthly lot rent by $50, they cannot afford to leave. Paying an extra $600 a year is painful, but spending $8,000 to move the home is impossible. The asset is trapped on your dirt by pure economic gravity. This captive demand dynamics dictates the physical layout of the property. Unlike modern suburban developments engineered for green space and wide setbacks, the traditional mobile home park is an exercise in extreme spatial density. High-density packing maximizes yield per linear foot of utility main. Every extra foot of asphalt, water line, or electrical cable you lay eats directly into your net operating income. Walk through a park and look closer at the infrastructure. You aren't looking at the homes. You are looking at the meters, the transformers, and the cleanouts. In a high-margin park, the owner avoids master metering at all costs. Master metering means the city sends you one massive utility bill for the entire park, and you have to attempt to collect sub-metered usage from dozens of tenants. If 3 tenants don't pay, you swallow the loss. In an optimized park, every single pad is individually direct metered by the local utility provider. The owner acts as a pure land leasing entity, passing 100% of municipal utility inflation directly through to the consumer. It sounds invulnerable. But under the top-line numbers sits a fatal operational flaw. The invisible infrastructure liability. When you buy a mobile home park, you aren't just buying land. You are buying a private miniature utility company buried 4 feet underground. Most older parks were developed in the 1960s and 1970s using cheap materials like galvanized steel, Orangeburg pipe, or polybutylene piping. Over decades, those pipes corrode, fracture, and leak. If a park has a master-metered water system and a main line breaks underground, thousands of gallons of water leak into the soil every hour. The city bills you for the loss. A single undetected underground leak can obliterate 6 months of net operating income in 30 days. If the park runs on a private lagoon or septic system, the capital expenditure risk skyrockets. The moment a state environmental protection agency deems your septic field non-compliant, you are forced to fund a modern wastewater treatment plant. A multi-$100,000 capital outlay that immediately wipes out your equity returns. Consider the case of Friendly Village Mobile Home Park in Long Beach, California. Built on top of a former landfill site, the ground beneath the pads began shifting and settling unpredictably over time, fracturing utility lines, causing methane leaks, and destroying structural foundations. Instead of managing an easy land lease asset, the operators faced catastrophic environmental liability, tenant lawsuits, and an eventual $56 million legal judgment and bankruptcy settlement that completely wiped out the ownership entity. Or look at Grand Valley MHP and its affiliated portfolio, which collapsed into Chapter 11 bankruptcy in 2024. The operators attempted an aggressive financial engineering strategy, splitting the park real estate and the home leasing entities into separate leveraged corporate silos, tied together with expensive chattel debt. When high debt service obligations coincided with skyrocketing maintenance and repair costs on park-owned units, the capital structure fractured under its own weight. The cash flow couldn't support the debt, and lenders forced the entire 29-park network into court-ordered liquidation. At the end of the day, the financial equation of a mobile home park collapses into one clean formula. Net operating income, even gross pad rent minus the total costs. Property taxes add money. Subsurface capex reserves add money. Legal.'s eviction drag when executed correctly in a fully direct metered park with clean municipal utility connections. The asset class yields some of the highest net margins in commercial real estate, often hitting 60% to 70% NOI margins. Institutions like Sam Zell's Equity Lifestyle Properties built multi-billion-dollar empires by acquiring these fragmented assets, professionalizing management, and reaping the steady inflation-resistant yields of land leasing. Because in the game of low-income housing, the real money isn't made by building shelter. It's made by owning the dirt beneath it and letting someone else pay to keep their own home stuck on your land.